This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I'm your host, Scott Meyers, and our next guest is my good friend, Jacob Vanderslice, who I met at a mastermind that we are both a part of. Jacob is a principal at Denver-based VanWest Partners, a real estate investment firm focusing on residential, commercial, and primarily self-storage, which is why we hit it off so well. He has been investing in real estate full-time since 2005 and resides in Denver with his wife and 2 young sons. VanWest Partners currently owns 23 self-storage facilities throughout the mountain, west, midwest, and southeast parts of the country, and they just recently closed a fund focused on acquiring underperforming self-storage facilities and then adding value through capital improvements, revenue management, and expense optimization. They now have plans to launch a subsequent fund with a similar strategy by the end of this year, which is the primary reason I wanted to have him on the show to discuss his efforts to raise capital. So without further ado, please enjoy this conversation with my good friend, Jacob Vanderslice. Hey, Jacob, welcome to the show.
Thanks, Scott. Thanks for having me on today.
Yeah, my pleasure, and good to catch up with you. It's been a little while, so I've given everybody a little bit of background on yourself and your bio, so if you would spend a little time, fill us in on the gaps and what you're doing right now, and perhaps even your plans for the rest of 2020.
Yeah, we're mainly a self-storage investment company, and we got started doing fix and flips back in 2005, 2006. We've done a bunch since then. It's still a line of business that we dabble in, but we saw self-storage as an opportunity in 2015. We like the business. It's repeatable, scalable. The revenue streams are pretty predictable. And we've grown our portfolio quite a bit since 15. Right now, we just closed out our most recent storage fund. We bought 11 facilities in a couple different target markets. We closed that down about 2 weeks ago with our last acquisition. And we're in the process right now of launching a second self-storage fund with a similar strategy, but just a larger capitalization. And we're mainly focused on existing self-storage facilities with the opportunity to create value with operational efficiencies, better revenue management, some capital improvements, rebranding. As you know well, Scott, probably better than maybe even I do. There's a lot of inefficiency in a marketplace. A lot of ownership groups are just unsophisticated and only own 1 or 2 facilities. And we think there's some opportunity out there to take advantage of that this year and next year.
Well, I know you and I have had conversations over the years, and I think for the past year and a half, you've been looking to make a transition a bit away from development, or at least not so development-centric, over to existing facilities. And, kind of curious as to how well that's going. And it sounds like you've got a lot of opportunities where it seems as if everybody else is singing the blues, saying the low-hanging fruit is gone of the unsophisticated mom and pops that we're selling out. But it seems like you've had some success. So, any secrets, and you don't have to reveal all, but how have you been able to source some of those opportunities and finding some of the mom and pop owners that are ready to sell now?
Yeah, to touch on the development question, the first part of it, we've done a fair amount of ground up development, and we're still interested in doing it. The reason we don't like that business as much now is we think investors and ourselves included are really focused right now on dividend and cash flow. And there's a lot of upside in ground up development, but there's no income from it for years, depending on the length of the project. So that's why we focus for the time being on value add existing facilities. We've done a few C of O purchases in the last year. Still risky, but not as risky as building them brand new. As far as deal sourcing goes, there's really not a lot of magic to it. It's just pounding the pavement. We cultivate a lot of broker relationships. And we actually applied some of our single family marketing practices to self-storage, doing direct mail, like a business letter saying, hey, we're a self-storage owner too. We're not brokers. We'd love to buy your facility. And I think we spent maybe $3,000 in direct mail, and we got $10 million in deals back in 18, early 19. Mm-hmm. So yeah, just grassroots marketing techniques and just pounding the pavement, building brokerage relationships. We got a few deals when we closed out our last fund that were off market. A couple guys that were active in the space were using CMBS financing for their acquisitions, and as you know, that dried up for a long time. Mm-hmm. It's definitely coming back now, but a lot of big buyers kind of paused during the height of the pandemic. So we were able to step in and get a few of those deals that we otherwise normally would not have been able to.
Mm-hmm.
but they're tough to find. It's competitive for sure.
Well, it is. Eyeballs have been on the self-storage space for quite a while now. And again, as we head into, well, we are in the trauma and transition business. And when there's trauma and transition in the economy, people turn to self-storage. And then when we head into the recession, investors begin to look more at self-storage because it benefits so much. And so, yeah, it'll continue to be competitive. But that's all right. For those of us that have been around a little while, we've been preparing for this for quite a while. So let's, what I'd like to do now, Jacob, I kind of want to do a little deeper dive on the syndication piece and the private equity piece. We have some folks that have done a few that have been guests on the show, but the level that you're going to and scaling up, tell us, I guess, first of all, I'd like to touch on some of the economies of scale that you're seeing. As you grow and as you're able to put more under your, in the portfolio, and under your belt from a centralized staffing standpoint, what kind of changes have you seen, and what does the, what does the bench look like right now as you begin to scale up again?
Yeah, we've built out our management platform the last couple of years. It's called ClearHome Self Storage. And the reason we did that was we just kind of concluded that nobody cares about your deal more than you do. We still have deals with outsourced management and they're doing just fine, but we like the transparency and the control. Having your own management platform, and you're a lot more aligned with your capital base, just because you just frankly care more. We've made a few new hires in the management platform in the last couple months. We hired a new property manager. We also hired, he's not directly in the management group, but an acquisitions associate who's underwriting deals, lobbing LOIs out to brokers, doing market research. We've also hired quite a few new on-site staff members that are new acquisitions as well. Once you get to scale, third-party management and self-storage doesn't make money until you have a lot of facilities and a lot of net rentable square footage. It's a very skinny business, but it's necessary, obviously. But as we grow the platform, a lot of the staffing is reimbursed at the property level. And as you get more deals and more units under management, you can actually lower your expense ratio because you can amortize those fixed payroll costs across larger facility or a larger number of facilities and units and net rentable square footage. So we're planning on, as we launch our next fund, we're planning on probably hiring at least another 4 to 5 property managers in 2021 to be able to service that portfolio. So it's been a positive thing once again, because you can just amortize those fixed costs across a larger asset base.
So the property management platform that you've taken in-house, are you going to be doing that for other folks? Or is it strictly for the projects that are in your fund?
That's not our intention in the near term. If it ever will be, right now it's only projects that we own, but it's possible down the road we could look at that. Mm-hmm. And as you know, a lot of the big players, the REITs, have expanded into third-party management the last couple of years. Mm-hmm. It's a fairly new thing for public. Mm-hmm. StoreQuest got into third-party management in the last couple of years as well. And they're seeing some success with that too. But once again, you just have to have enormous scale for it to make sense.
Mm-hmm. So I'm curious on a personal level. We've always used third-party property management companies because I've gone kicking and screaming into building out our own as well. And now we're already adding asset managers in different layers, so that we're beginning to look like having our own property management. But we've always wanted to have that third-party company in place because they know the market best and they keep up on it. From the HR standpoint, bookkeeping and everything else, it's stuff that we're just not prepared for. But also to have that arm's length, for our passive investors, our equity partners that are coming in. If you begin to fee things up and if everything is under your control, some folks begin to turn up an eyebrow and say, well, hold on a second, Scott, you get fees for this and this, and you're controlling and running a lot of this. Where's the check and balance? And that's one of those places that seems to get scrutinized. So just curious at the capital raising level, whether it be on an individual basis or in the fund, have you found folks have pushed back? Is it can always be sold as a benefit for the reasons you just mentioned. We all know that nobody's going to care as much about your facility as you do, not even 1%. But have you seen any pushback, or has that been a positive once you finally took that in house and then have stated that to the rest of the world?
It's been a positive for our capital base, and I could completely see how there could be some concerns about misalignment. We're doing a couple things differently in our management platform that a lot of the third-party REITs do not do. One thing we're doing is 100% of our tenant insurance revenue flows up to the fund level.
Mm-hmm.
Extra Space, for example, great company. They've managed a few of our facilities over the years, but they keep 100% of the tenant insurance premium revenue uh, without sharing it with their owners.
Mm-hmm.
So that definitely moved the needle for us in terms of the net revenue and dividend to our capital base and to our fund.
Mm-hmm.
We've also been able to be a lot more transparent with our advertising allocations. So, for example, the big players will just give you a blanket advertising fee per facility,
Mm-hmm.
and there's some sort of black box algorithm that they allocate those dollars that you're really not privy to. In our platform, we can point to where every dollar goes at the facility level and subsequently the fund level. So the expense transparency, being able to account for advertising spend more accurately, and then passing through all the tenant insurance revenue arbitrage to the fund, to our capital base, have been positive things on the management side.
Mm-hmm. Yeah, in all fairness, third-party companies, they're a necessity, but also a choice, and they do a fantastic job in so many areas. But as they grow, they lose the ability to do those things that you just mentioned at the site level, which is you're going to be heavy in marketing when you're in lease up of a project that's been recently built or converted. But that doesn't have to be a static annual figure going forward when you get stabilized, and some of those are just baked in. And there's many of those costs where you look at a management company typically in the 5 to 6% range in terms of their fees. But when you add in, their own call center and some of these others, it very quickly gets up to about 8 or 9%, and there's nothing you can do to control that. Whereas if it's at, your control at your site, you're able to do so. So
Yeah, that's
all
one thing
reasons.
that took me way too long to learn in the self-storage industry. But if you're paying a 5% fee, you're really not paying a 5%
Right.
fee.
Yep. It's a standard for underwriting that gets it through the bank. But
Yeah,
yeah, when you peel back the onion, looks a little bit different than that.
absolutely.
So let's talk a little bit about just that as you're building this out, when you're looking at let's say the management level itself in terms of deploying regional supervisors across the portfolio. What does that look like in terms of how they manage the facilities and the control that they have over the site itself?
Well, we're doing two different types of facilities. In Fund One, all of our facilities are not staffed full time with a person.
Mm-hmm.
And the reason they're not is because they're small enough where it doesn't make sense to have a full time on site staff member. Um, so in those facilities, we have rovers who go do unit checks, unit walks, repairs and maintenance, but they're not full time sitting at the site. As I'm sure you have in your portfolio, whether it's staffed or not, all of our customers can lease a unit online, make their payment online,
Mm-hmm.
move out online, basically get all the stuff they need either on their smartphone or on a website or over the phone with our call center. On our larger facilities we've acquired recently, those have been big enough to support full-time on-site staff members. And it's frankly easier to manage a self-storage facility with somebody there full-time if you can afford to do it.
Mm-hmm.
We've actually been able to keep a number of the existing on-site staffers from the prior ownership groups to stay, which has been positive because they know the facility. But the layers underneath them really, we've got our director of operations in the office who oversees our two property managers in the office. And our two property managers kind of split our facilities up and either run our part-timers who do repairs and maintenance and unit checks and any customer service issues that arise that need a person to be there, and then they oversee our full-time on-site staffers at our staff facilities as well. So we kind of have a hybrid. We have unstaffed and staffed facilities within the portfolio.
Mm-hmm. And I think when you have a portfolio, when you get to the level that you are now and that we're getting to, the same thing applies. It's not a one size fits all. Whereas we're always going to have somebody, whether it be part time or full time at a site. We do have facilities that are unmanned, and it just makes sense to do so. And at our other facilities, technology may take the place of a part timer instead of adding an assistant onto those. But we're taking a look at those at the site level just to see what makes the most sense, and whether it be manned or unmanned. But let's I wanted to get back into talking about the fund itself. When we were talking off camera ahead of this, you had stated that the funds that you are raising are both equity and debt. So if you could explain to the folks what that looks like, and as you're raising capital for the other syndicators out here, to get a sense of as they head into perhaps their first fund or the next one, like the larger one you have. Talk a little bit about the structure of how you come up with the mix.
Sure. Yeah, a syndication is really no different than a fund. A fund is basically a syndication that's a collection of assets. Typically, a one-off syndication is a special purpose entity that's formed to only buy one deal, and the sponsor raises capital for that one deal and executes the strategy with that one deal. And a fund is just a collection of deals, so it's really similar overall. Just the risk profile is spread across a larger asset base. In theory, with a fund, if you have 10 deals, for example, maybe 2 don't go very well, but the other 8 do really well, and they make up for any shortfalls in the first 2. It's a better risk profile for an investor, I think, than being in one deal that may or may not perform. And if it doesn't perform, it's the only deal that you're in, and you could have a problem down the road. We do one-off syndications, of course, but that's one of the advantages of a fund. The capital structure for the fund that we just closed is fairly straightforward. We have an 8% accumulating preferred return that gets distributed quarterly. And for those of us listening who don't know what a preferred return is, it's kind of like an interest rate, but it's not guaranteed. And it's designed to get investors the first series of net cash flows up to a certain annualized yield. And in the case of our fund, it's an 8% preferred return. Distributions after the 8, 100% of those go to pay down capital accounts. So if we distribute more than an 8% return, anything above and beyond that will go to reduce the investor's original invested capital. After their capital is completely returned, the split is then 70-30 in their favor, pro rata with their capital contribution. We designed this current fund that we just closed to really be focused on income, and there's some appreciation and upside as well down the road. The gain on sale, refinance proceeds, replacing equity with debt. But it's really designed to create quarterly distributions that are consistent, which people seem to like lately. So yeah, that's the overall structure. The fund that we're launching in Q4 of this year is going to be pretty similar. We might have some different tiers of capital accounts with better economics with larger investment. So for example, maybe if you invest $1 million, your split's 80-20 versus investing $50,000, your split might be 70-30. So other than that, it's going to be fairly similar to the current fund. Just in general, we're targeting larger acquisitions, larger net rentable square footage, and just larger basis in general. As you well know, Scott, it takes as much time to do a small deal as it does a big deal, if not more time. And you're still ordering the third-party reports, you're still facilitating the capital raising, you're still dealing with the management transition issues. And we'd rather do that on a larger basis than a smaller basis.
Well, so let's talk about the capital raising. We right now there's I guess the best way to put it is perhaps a lack of clarity in the market for our equity partners. Some are holding on to cash, thinking that maybe there's a better deal coming down the pike, or just because they don't know when they may go back to work. In some instances, they're keeping an eye on the stock market. They pulled some money out. They're looking to maybe invest in a fund like yours or into an individual facility, or do they just hold on to it? In terms of the velocity of how you're able to raise capital right now, are you seeing a slowing? Is there kind of a pushback? Or are you seeing a surge of people coming out of the stock market, or converting their 401ks over to self-directed to get into these hard assets as we head into a recession? What if you've done any polling at all? What does that look like from your base or the new folks that are coming in right now?
We had, I would call it a surge in probably the last 2.5 months. And it's been a combination of reasons, I think. Part of it was we were closing out our fund, and people who were kind of kicking tires for a while decided they wanted to get in. A lot of folks that we're talking to lately have seen newfound interest in alternative asset classes like real estate. The nice thing about real estate, which is why I got started in real estate, it's a hard asset. And I'm not smart enough to understand the stock market. You have no control over it. If your stock goes down, all you can do is sell it or buy more. You just can't do anything about it. Real estate, if it's not going well, you can actually do something to improve the situation. Let's say your leasing's not going well, you can lower your rates, or you can advertise more. Or if the building isn't looking good, you can repair it and make it look better. There's things you can do proactively to improve the performance of your real estate asset base versus the stock market, which is why we like it. I think a lot of people too have just been tired of the ups and downs they've seen in the stock market. And
Mm-hmm.
obviously we've got a contentious situation in the country right now with the election year and everything that's going on, which we don't need to expand on because everyone's well aware of that.
Mm-hmm.
But people have definitely seen a newfound interest in alternative real estate investment opportunities. And it's been a combination of, like you said earlier, people converting their self-directed IRA out of the stock market into real estate, people kind of sitting on some cash, wanting to put it to work for a decent yield that's predictable and repeatable, without the ups and downs of traditional publicly traded securities.
Yep. Yep. So what does the 2021 look like for you? You've got some aggressive plans and with the next fund. So how do you plan to deploy that capital? What do you see in the horizon for 2021?
We are not seeing a lot of distress in the market yet. We're seeing inefficiency, and we're seeing deals we probably wouldn't have seen prior to the pandemic, but we're definitely not seeing fire sales yet. I think that's coming in the asset classes that have gotten hit really hard, like retail and hospitality, of course. A lot of default rates in the CMBS markets on those types of deals. But within self-storage, we're not seeing any properties are just being given away for big discounts. So we're mainly targeting acquisitions with good in-place cash flow, with good T12 financials, with a lack of downside, but a good amount of upside. So frankly, if we buy a facility and we screw it up, and we don't raise rents like we thought we could, we don't lower expenses like we thought we could, we're still going to have a good dividend on that deal, and we're still going to have long-term upside on it. But yeah, 2021 is really just going to be a big focus on deal flow and capital raising. Our next fund is a lot larger than our first. We're doing a total of 100 million, which is roughly 70 million in debt, 30 million in equity, and our last one was 30 million, roughly 20 million in debt and 10 in equity. So we've got our work cut out for us. And as I know you're used to this, Scott, capital raising and deal flow are never perfectly in balance. We always have too much of one and not enough of the other. Inevitably, they never line up perfectly, but that's life in real estate, I guess.
Yeah, it is a full contact sport these days, and
It sure is.
the rules seem to be changing. Not too much, but just a little bit that we have to keep up with. But Jacob, you're doing an absolute masterful job. It's been great to be able for us to just share best business practices over the years, and you and VanWest are doing some incredible things. So I want to thank you once again for your time today. If as we wind up, if you could maybe talk a little bit about your secrets to success and what that looks like for VanWest. How have you been able to grow at the pace you've been able to?
We've pivoted our business several times since I've been investing in real estate full time since I guess 05, 06, and things that continue to work for a while inevitably stop working. For example, our main line of business until really 2015 has been single family residential. And we used to source deals almost 100% at the foreclosure auction. So we go to the trustee sales with cashier's checks, we'd buy a bunch of deals, we'd renovate them, we'd sell them, we'd do it again. We didn't have to be marketers because you just show up with your money and you buy the deal and you put it on the MLS and it sells itself because you did a good job in the rehab and you priced it right. When the auctions dried up, we had to pivot to direct to seller marketing, and a lot of that we learned in Collective Genius. We kind of went in there for the first time having no idea how to do direct mail and PPC, and that's worked well for us. But we just weren't doing enough volume, and we wanted to do bigger assets, longer term deals, which got us into retail. Adaptive reuse retail, kind of converting old warehouses and tired buildings around Denver into breweries, restaurants, coffee shops. We've sold some of those. We've held on to others. Thankfully, all of our tenants but one made it through the pandemic, and everybody's paying rent again, which is good. And then we just identified self-storage as a great asset class. One of my partners had some experience doing CMBS underwriting and self-storage, and his family built a facility many years ago out in California. So we took a look at it and like, yeah, let's go for this. And we found some high net worth partners in Denver with some institutional capital behind them. We built our first round of facilities and kind of grew it from there. And the success, the success effort is ongoing, right? It's a challenge every day. One of your questions you sent me earlier was kind of how self-storage can be misunderstood sometimes, and that it's easy to manage.
Mm-hmm.
And that's true to a degree, but it's painful every day. We have customer service issues. We have people sleeping in units sometimes, which I know you're familiar with in our urban infill locations. We have gates going down here and there. Customers can't get inside. So it's definitely not a fire and forget business. It's a grind every day, but we love it. And, finding deals and putting the team together to execute the strategy is what we enjoy. Our main goals really in the kind of near and medium term is we want to build an asset base that doesn't require a sale to have it make sense. We want to build an asset base that doesn't have to sell in 2 years for the pro forma to work. We want long-term predictable revenue streams, the tax advantages that come with holding real estate. So really just trying to accumulate and just create good passive income streams for ourselves and our investors. And it's an effort for sure.
Well, as they say, if it were easy, everybody would be doing it. And I think that is a true test of it. Any asset that you bring into the portfolio needs to stand on its own, and that it's not profitable, or the bulk of the facilities aren't profitable because of an exit strategy that involves a sale or a massive refinance. So if it all can stand on its own, we all make money in investments when we buy them, but if you really buy them right, and it's a buy and hold, and it remains profitable without a sale or a refi, then you've got a good asset base. And so very, very good formula. So with that, once again, Jacob, I appreciate your time. If you would perhaps share what is a good book you've read or that you're reading recently that you found that you may want to share with folks.
Let's see here. That's a great question. I regrettably mostly read historic nonfiction. I am not I read a lot of real estate books, but not nearly as many as I should. One of the greatest books I've read in recent history is a book called In the Kingdom of Ice. And I don't have the author handy, but it's basically a story about polar exploration. Kind of like Shackleton, but not exactly. These guys thought that if they got far enough north back in the late 1800s, there wouldn't be any ice because the ocean would be warm and they could just go over the top of the world to get to Russia or China. And they found out, obviously, that there was ice, and they got stuck. And they were stuck in the ice for months, and they walked out like 1,000 miles into Siberia, and a bunch of them passed away, but a lot of them made it out, and they hiked back to get their buddy's stuff who had passed away. And it really, we had some challenging times right now, but books like that really put in perspective how much worse it can get. And whether you're a real estate person or not, it was very, very inspirational for me.
Well, I'm the same. I do read real estate books and things that will add on to this, but I like historical biographies, especially drawn to the robber barons of the turn of the century, the industrialists, and back in the day when J.P. Morgan was the J.P. Morgan, we're doing multi-million-dollar deals, tens of millions of dollars of deals on a handshake. And the real estate that was created, wealth that was created in this country from the industrialists, that to me is just fascinating to see what's going on at the time. And I think the lessons you learn is that once again, the more things change, the more they stay the same, but also have a little bit of, envious of the way the business was done back then versus the way it's done now. So who knows, maybe they'll write a book about these times, but.
That's right.
All right. So with that, Jacob, what is the best way for folks to be able to get in touch with you?
You can go to our website, which is vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice with VanWest.
Perfect. Well, Jacob, I look forward to the time where we're able to get together again in person and live, but it's been great catching up with you here on this call and on the podcast. So thanks again, and we look forward to seeing you again very soon.
Thanks for having me, Scott. Appreciate it.
All right. Take care.
Talk to you.
Ladies and gentlemen, thank you for listening as always. Now, we're going to be talking about topics like this that are on target for the times that we find ourselves in. So it is important that you are listening to this podcast every single week, because the guests that I'm going to be bringing on and the topics we will be covering are relevant to what we are all going through right now. And it's just going to get better and better and better in terms of the content that we're going to be discussing, and it's going to be more timely than ever. So please, Make sure you subscribe to the show and make sure you're paying attention to these episodes as they are coming out during this period, as I am specifically going out and finding guests who are providing really valuable information you need right now. So thank you so much. We'll see you next week.